And we are live. Thank you, everyone, for being here.
Hi, everyone. Thanks so much for joining our live on student debt. I'm Meredith Jones. I'm a veterinarian and the co-founder of Veterinary Financial Summit. I graduated back in 2008, and so I was able to, at that time, take advantage of low interest rates on student loans. And so I was able to pay off my student debt in about 3.5 years once I got serious about it. Willie?
Well, 3 years is pretty aggressive, and that's awesome. Well, I'm Willie B. Dutt. I am a lab animal specialist in Pomona, California. I graduated from Tuskegee University in 2014. At that point, I went to an internship and went through the 6-month forbearance period. So I actually started paying off my loans after those 6 months, went into an income-driven repayment. My wife is also a veterinarian, so that really got me into learning a little bit more about our student loans because her and I have about $430,000 in student loans. So yeah, and fortunately, I have been in a nonprofit environment for the past 7 years. So I'm going through a program called PSLF, Public Service Loan Forgiveness. So please make sure to like us on Facebook for future events. We're going to try to do some events about personal finances. And of course, we wanted to start off with student loans because we get so many questions of student loans. And the first question is, so you graduated and you have a lot of student loans, which is now common, unfortunately. What's next?
So there are a lot of repayment plans, but there are really just two main strategies for paying off your student debt. You're either going to pay it off quickly and in full and just pay it off as quickly as possible, or you're going to go for income-driven repayment, which is where you're going to pay the minimum that you absolutely have to pay toward your student debt. And then after 20 to 25 years, the remainder is going to be forgiven. So those are the two main strategies.
And how do you decide between those options?
Yeah, certainly a really common question. And so there are a lot of nuances of student debt, so it gets to be a rather complicated question. But when we're talking about strategies, one of the things that we do is we talk about rules of thumb, and we talk about debt to income ratio. So the debt to income ratio is the ratio between your debt and your income. And so an example of that would be if you have $200,000 in student debt and your compensation is $100,000, then you would have a 2-to-1 debt to income ratio. And so the rules of thumb that I typically talk about with debt to income ratio, if your debt to income ratio is greater than 2-to-1, and if it's likely to stay there over time, then you're probably going to go for income driven repayment, or a lot of people call it one of the government forgiveness options. If you are between 1.5-to-1 and 2-to-1, then that's a gray area where some vets will decide that they're going to go for income-driven repayment and get forgiveness on their debt after they pay for 20 to 25 years. And some people, depending on their goals and their situation, may decide to pay it off aggressively in a short period of time. If your debt to income ratio is less than 1.5-to-1, then you could consider paying off your student debt as soon as possible. And when I say as soon as possible, I'm typically talking about less than 5 or 6 years. Some people say less than 10 years, but the longer you go before you actually pay off your student debt in full, if that is your strategy, the more time you're taking away from your other financial goals, like contributing to retirement, for example, or in some cases saving for a major either career change or a major purchase like a home. So certainly paying off your student debt in full in a short period of time, it's not going to be feasible for everybody. And so certainly that's okay. And that's why the income-driven repayment plans exist. And so the date today is June 21st, 2022. And so right now there's a payment and interest freeze, and it's set to expire at the end of August. And so, Willie, how can you prepare for the payments restarting?
So first of all, I think it's going to probably be extended. I think it's going to be extended till the end of the year at least, but we'll see. What do you think about that?
Yeah, I mean, I think it's likely that it's going to be extended. Certainly, we always have to, with student debt, we have to take into account, okay, this is what it is now. So right now, supposedly it's going to be end of August, and then you'd have to start your payments again probably in October. But yeah, I mean, it's probably with the election and everything else going on, it's probably going to be extended through the end of the year. So certainly keep your eyes peeled for that.
Yeah. So, but the first thing would be, it would be based on your plan. So payments are restarting. Are you paying them off, or are you in income-driven repayment? If you're planning on paying them off right now, you have a 0% interest loan. So anything that you put in will go to the principal. So that is amazing. That doesn't happen ever. Nobody will loan you money for free. But if you're in an income-driven repayment, and I was thinking about it, there's people that graduated in 2020 that have never made a payment to their student loans, and that's crazy. But if you're in an income-driven repayment, you're going to have to pay back your loans, or at least the monthly amount that you have allotted for that. So make sure that once payments start, you put another line in your budget that says student loan payments.
And so, I mean, Willie, do you recommend doing anything else in the months beforehand to prepare, like pretend like you have a student loan payment or anything like that?
Well, I'm going to use myself as an example, since me and my wife both have student loans. So yeah, once the freeze, whatever you want to call it, started, of course, we didn't have to make any payments to our student loans. So what I did is I was already preparing for my tax bomb, which we're going to talk a little bit about it later, I guess. But I'm preparing for my tax bomb plus paying for my student loans. Now what I'm doing is I'm putting more money to my tax bomb to prepare for it actually earlier than I thought. And once repayment starts, then I'll divvy up that again and make sure I'm paying my student loans and also still investing money for my tax bomb. Meredith, what is a tax bomb?
So the tax bomb. So some people call it a tax bomb. That's what I like to call it. Some people call it just a tax bill. And so really that's one of the most common mistakes that we see vets making, is being on an income-driven repayment plan and not saving for the tax bomb. So if you are on an income-driven repayment plan, and if you are going to reach forgiveness, you want to make sure that you are saving for the tax bomb. So those are the plans like pay, repay. Some graduates years ago maybe on IBR, which is income-based repayment. And so the thing is, you're going to have to pay taxes on the debt that is forgiven in 20 to 25 years. And what happens the year it's forgiven is it's treated as taxable income. And so an example of that would be if you have $300,000 forgiven, which is going to be the case for some vets out there, and you're in a 30% tax bracket, then you're going to have $90,000 saved up in order to make sure that you can pay that tax bill and that you don't get in trouble with the IRS. So that's what the tax bomb is all about.
And Jonathan made a comment about no payments at all here, not ready to start either. Yeah, it's tough. Again, another item that you have to add to your budget.
Yep, absolutely. Yeah, and I would argue two line items to your budget if you're not saving for the tax bomb. So you've got the student loan payment, and if you're on income driven repayment, then you're going to need another line item for that tax bomb. So yeah, it's an unfortunate reality in our profession.
Yep.
Yeah. And so on this live, we're going to cover a lot of basics. And so certainly there are, like I said, a lot of nuances with student debt. And I'm going to dig into more of those nuances more at a student debt workshop that we have coming up at the Veterinary Financial Summit. And so what we're going to do with that is we're going to go a lot more in depth. We're going to run through some case studies, and the next Vet Financial Summit is going to be held virtually on October 22nd and 23rd. So mark your calendars for that. If you'd like to go ahead and join our email list, go to vetfinancialsummit.com to learn more about that.
It will be a great summit. Another common mistake that we see is people throwing extra money on their debt while they're in an income-driven repayment plan.
Mm-hmm.
And, of course, if you're on track of forgiveness, Meredith, what do you think about this?
Okay, so this is what we see all the time, and we have folks on the Debt-Free Vets group, because we're both admins for that. We have people who post and they say, gosh, well, I'm on an income-driven repayment plan, I'm going for forgiveness, but whenever I get some extra money, I throw it on the debt. Well, you might as well be throwing the money out the window. Because the thing is, if you're going for forgiveness, there's really no advantage to paying any more than the absolute minimum that the government tells you you have to pay based on your income. And so that's a mistake that we commonly see. And certainly if you've got extra money, what do you do with it?
Well, there's a few things that you could do with it. You can go crazy with it. But main things that I would say would be, make sure you have a good emergency fund. And, depending on who you're talking with, the emergency funds means very different things. I usually suggest about 6 months of expenses. So make sure you have a good emergency fund. After that, you can start targeting other loans. If you have credit cards, make sure they're paid off. If you have a car loan, hey, just put money into that. Or even if you have a mortgage, which might be a low interest loan, but still, if you want to put money somewhere, put it into that. And if that's not the case, where you don't want to go ahead and target any of those loans, then I'll probably invest the money. And that's what I am personally doing. My only loans are currently my student loans. So I'm investing money.
Mm-hmm. Yeah, lots of options that we have. So, okay, so we talked about a couple of common mistakes that we see. Another common mistake that I see is getting the terms consolidation and refinancing confused. And so not only can the terms be confusing, but if you are confused and you act on it, and you're confused, then you could be making a really big mistake and lose a lot of money. So want to make sure that we understand the difference between those two terms. And so with either consolidation or refinancing, both of those mean that you are paying off multiple loans and creating a new loan. With consolidation, the word that you want to keep in mind is federal. So it can only be done with federal loans, and consolidation is only available through the government. And so the common time that we see people consolidating their loans is typically soon after graduation. And there are also a lot of nuances with whether or not that's a good idea, but that's usually when we see that happen. With refinancing, it can be done with either federal loans or with private loans. With refinancing, what happens is the loans actually, if they're federal, they become private loans, and you have to pay them back just like any loan from the bank or any other typical loan in life. And so if you have federal loans and you refinance those loans, then those federal loans actually become private loans, and they're no longer eligible for the income-driven repayment programs. And so if you're thinking about refinancing your loans, then you want to make sure 100% that you're going to be able to pay off those loans in full. And so to recap that, consolidation is taking more than one loan, more than one federal loan, and consolidating it into one federal loan. If you have federal loans and you refinance, then those federal loans become private loans and they're no longer eligible for income-driven repayment or for the payment and interest freeze that's happening right now.
Yeah, that's something we see a lot of people using those two words interchangeably, and they're very different. There is another comment that Jonathan is going for PSLF, fortunately, and all these zero payments have been all counting towards forgiveness, which is true. So people like myself have not been paying anything to their loans. They have to make 10 years of payments, so a total of 120 payments. And every month that goes by, we're not paying anything, but it still counts for that forgiveness. And in our case, for PSLF, Public Service Loan Forgiveness, it's non-taxable. It's not taxed. So it's a complete forgiveness, which is amazing. So again, due to the current environment, student loans are just an ever-evolving subject. We never know what's going to happen next week. The deadline might change, so we never know. So all you can do is prepare with the information that you currently have. So again, we talked about emergency fund, saving money for the tax bomb. That you do that with the information that you currently have. And I guess that's about it. We don't have any other questions. So thank you all for joining us. If you have any topic suggestions for our next live, please write it down in the comments, or feel free to message us at Veterinary Financial Summit through Instagram or Facebook. Thank you, everyone.
Thanks, everybody.